Pankaj Murarka joins us and doesn't matter bull market, bear market. Pankaj bhai chalta rehta hai. Let's start the interview with a smile on your face.
Morning, Nikunj.
You have to prompt everybody to smile in this market. I said that markets are down 30%, but they're still 60% up from where they were 2 years ago.
Absolutely. And the bull market still holds. So we are very much in a bull market. Maybe it's a slightly more matured bull market than what it was 5 years back. But having said that, we have to consider the fact that we have had one of the most ferocious bull market that I have seen in my career after the technology bull market of 99 and 2000. Probably this has been the most ferocious one. So the kind of gains that we've had in this bull market over the last 5 years have been pretty strong and very phenomenal.
Talk about something which you got it absolutely right, and I think everybody wants to know that where is that cluster headed? Fintech and consumer tech, right? You bought into Paytm when everyone said no. You bought into Zomato when everyone says no. You bought into Policy Bazaar when everyone said even a bigger no. Now that everybody started saying yes to these stocks, the earnings are a bit shaky. From Zomato, from Paytm, Policy Bazaar, I think numbers have not come out, but the two horsemen, first Zomato and then Paytm, numbers were shaky.
Well, Nikunj, we look at numbers in the context of the expectation which the street is set. Look at these businesses from the perspective that all of these companies are just about 10 years old. These were businesses which were set up 10 years old, 10 years back. 10 years back, food delivery industry did not exist. And today it's an industry which does over close to about $10 billion of gross order value. Uh, uh, Zomato is probably, in my reckoning, one of the fastest company to get into an index, Sensex, in within 10 years of their formation. No other company, if you look in Sensex, has been able to get into the top 30 or top 50 companies of India within the 10 years of their starting date or in the first 10 years of the life cycle. That shows the kind of growth, exponential growth curve that these businesses have been in the first 10, 12 years of their being around kind of a thing. So while the numbers being somewhat under expectation, higher competitive intensity, few more players coming, and all of that is more in the context of what markets or analysts expect from a quarterly perspective. I still think on a longer term basis, these businesses still have a very long growth curve ahead of them. I still hold my view that some of the leading companies of India, probably 15 years out, will emerge from uh, disruptive tech, be it consumer tech or fintech. I think one of the top five financial services company will be a fintech 10 years out, because consumers like you and me are doing all our financial transactions now through help of technology rather than the old traditional way of visiting branches of banks or NBFCs. So I still think that given the fact that numbers were somewhat understated, meaning under expectations, valuations had run far ahead, probably the trade had become too crowded because stocks have done phenomenally well. And as you rightly said, life has come full circle for some of these companies. Two years back or 3 years back, when Zomato was at 50 rupees or Paytm was under 400 rupees, no one wanted to own them. And today they've become some of the hot favorites, and most of the portfolios and investors have these stocks in their portfolio. So probably it could be a time for some calibration, some consolidation. But for longer term investors, I think I still think that these companies will be some of the fastest growing companies of India over the next 10 years. I think that story or hypothesis still remains very much in place.
Let's talk about specifics here, and I'll pick up Zomato just for discussion purposes. Long, short, we are not getting into recommendation. Is the quick commerce space getting competitive, or what Zomato is doing in terms of investing upfront, is that the right strategy?
I think so. I'll give you a context. When Zomato came into food delivery in 2013 or 14, there were 15 players. Given the nature of technology-oriented businesses, that these businesses have access to huge amount of capital, and they are very aggressive in terms of execution. Today, 10 years out in food delivery, we just have two players, and these two players, Zomato and Swiggy, control about 80% of the market. The good thing about technology-driven businesses is competition is very intense and probably very cutthroat. It's survival of the fittest, but you achieve industry consolidation at a very early stage in the life cycle of a business versus traditional businesses. Just to give you a parallel, let's say just think about cement as a business. Cement industry has been around for 100 years. And even today in India, you have 50 cement companies, because an industry still remains fragmented after being around for 80 or 100 years. Uh, what happens in these technology-driven businesses, because the competitive intensity is so intense that and the cutthroat competition forces industry consolidation in early stage, which eventually lead to a oligopoly kind of a situation. For example, the kind we have in food delivery, and which effectively means the profit pool for the winner or the person who's able to survive, the company which is able to survive, is pretty large and for a very long period of time. So I think quick commerce is exactly going through the same cycle which the food delivery business went through in the first 5 years of its evolution. So I think Zomato is doing exactly the right thing, being as aggressive as some of the other competitors are, and probably hold on to its pole position or a leadership position in Blinkit, which is very critical from a longer term profit pool perspective. It will hurt them in terms of bringing forward losses, and probably they'll end up burning much more money in that sense. But I think from a longer term strategy point of view, it makes imminent sense.
Right, quite interesting. Pankaj, that was the case study on Zomato. But what about other buying opportunities, if you think there are any emerging already?
Well, after a long period of time, I've got very constructive. After almost 3 years, I've got very constructive on a very boring name called HDFC Bank. Uh, I think HDFC Bank is in the last leg of their consolidation challenges, which they've had post their merger with HDFC, probably another 2 or 3 quarters. HDFC Bank has gone from a position of being the fastest growing private sector bank in India over the last 20 years to being the slowest growing private sector bank in India in the last 3 years. My view is that I think all the foundations are in place. And probably once they navigate these challenges of merger over the next 2 or 3 quarters, probably in 3 years' time, I think they will get back to a position where they will re-emerge as the fastest growing private sector bank in India. And valuations at 12, 13 times forward earnings, adjusted for their subsidiary values, at about almost 40% discount to index, are extremely compelling. As investors, we want to buy growth and good quality growth companies at reasonable valuations. I think these kind of valuations for HDFC Bank are very compelling. So some of these stocks which have not done well over the last 2 or 3 years for specific reasons, and probably are underowned at this point of time, looks more attractive in the context of the market where valuations are in a lot of pockets of markets. All of us, I think, acknowledge that valuations are extremely rich and frothy, and which is where we're seeing that pullback or mean reversion. So I still think there are pockets of markets where valuations are attractive, and HDFC Bank is one of those which we've started liking quite a bit.
You're just playing safe because the Pankaj that we know hits out, hunts out mid-cap gems.
No, not really. We always growth bias, meaning I think HDFC Bank as a stock can double over the next 4 to 5 years. Now, 18-20% CAGR returns from someone like HDFC Bank, which is a large bank, stable bank, steady bank, is pretty exciting. Whereas in case of mid caps and small caps, while we like a lot of these companies, but we have to acknowledge the fact that we are at a stage in this bull market where valuations are far too ahead of the fundamentals. So essentially, there has to be a mean reversion. And some of these companies, because the economy is in the midst of a cyclical slowdown, I think there will be more earnings disappointment along the way as we navigate this earnings season, because we're still in the early days of this earnings season. So we have to be mindful of valuations while we want to buy good companies, but at the same time, it's very important them buying them at the right or reasonable valuations in that context. So yes, I to that extent I concede that one should probably hold out or some dry gunpowder before chipping into mid cap or small cap space.
Let's say a portfolio in last one quarter, 1st of October to 1st of Jan, or 15th of October to 15th of Jan. Markets have changed, world has changed, stock prices have changed. What have you changed in your portfolio?
Well, Nikhil, what we've done over the last, I would say 6 months, not in the last quarter, but in the last 6 months, is we have significantly pared down our exposure to some of the to defense and engineering cap goods as a sector. We were pretty overweight or heavy on that as a sector over the last 3 years. But post the election outcomes in July, over the last between July and October, we have completely exited our defense exposure. We don't have any exposure to defense now. and we have significantly pared down our exposure to capital goods. And my view is that one of the big drivers of growth for India over the last 3 years has been the significant increase in central government capex, which actually has gone at almost like 3.5 times from 3 lakh crores in 2020 to about 11 lakh crores this year. But I think that is peaked now. Incrementally, central government investments or capital expenditure will grow at nominal GDP growth. And unfortunately, while private sector capex has come back, but it's not come back to the extent it was expected that it will take over the burden from the central government capex. So it looks like that from here on, while investments will be a driver of growth, but that growth will significantly moderate. And I think valuations in that space, given that the stocks have done exceedingly well, are very expensive. Even mid-cap and small-cap companies and engineering cap goods are trading at 50, 60, 70 times multiples. And I think the implied growth in these companies is unlikely to be met. So there will be growth moderation in the sector, and some point of time, there will be a mean reversion in stock. So what essentially we've done is we've taken money out of engineering and capital goods as a sector, and we've moved that money, as I said, to some of these old traditional names like HDFC Bank and Reliance, because some of these stocks have underperformed over the last 3 years. Valuations there have become much more reasonable, and one of the few pockets of markets, let's say private sector financials, is one of the pockets of the markets where valuations are actually a discount to the index Nifty. There are very few pockets in terms of secular growth stories where you find valuations at discount to the Nifty index. Private sector banks is certainly one of them. So we think, and the headwinds that were there for private sector financials for the last 3 years, we think those headwinds are clearly abating. So we see a better growth for some of the sector going forward. So we moved money from engineering and cap boards to private sector financials and to IT as a sector. IT is one, IT services, I continue to remain positive. But there also valuations at this point of time are slightly ahead. The returns have been front loaded because the sector has done well in the last 3 months. But I still think over the medium term, the sector will do well. So we've actually moved, as I said, money from some of the engineering and cap board names to private sector financials and IT.
Pankaj, given the slowdown in the earnings, some are also debating for the fact that maybe the second half of this year looks fairly better in terms of the earnings growth outlook in comparison to the first half. And even you were highlighting that the markets are not looking that great, betting on some of the large cap names like HDFC Bank. Share your thoughts on the same, that if the second half is looking better, then what should be the investor strategy at this point in time?
Not really, because while second half will be better than the first half, but our understanding from our conversation with the companies and the macro and the micro data points that we track and we observe, the recovery in earnings in the second half will be some very modest in context of the first half. It's not going to be a very significant recovery. The fact is, we need to acknowledge the fact that Indian economy is in the midst of a cyclical slowdown. The slowdown started with rural consumption 6 quarters back, but over the last 4 quarters, it has become more pervasive, and it is spread across almost all the segments of the economy. You're seeing a sharp slowdown. You see passenger vehicle sales growth is down to low single digits. Apparel sales in a country like India have been recording negative growth at the aggregate industry level over the last 4 years. So what started as a slowdown in rural consumption has spread across urban consumption and other pockets of the economy. Corporate India, while they've been investing, but the investment pickup is very modest in that sense, and the mood there is not of is there of cautious optimism. So while corporate India remains optimistic and they want to invest, but it's a more measured investment that corporate India is engaging into. And given all of this, and given the fact that the central government capex has peaked, I think we need to accept that this year, FY25, is going to be the slowest earnings growth in the Nifty index companies in the last 5 years post COVID, at single digit about 8 or 9%. Given the context that there's not much fiscal room for the government is in the middle of fiscal consolidation. I think the monetary cycle or the rate cycle we get into is going to be a very shallow rate cut cycle this time around, because the latent inflation still is remains very much there in the system. And given the context that we do not have enough drivers of growth, I think we have to reconcile to the fact that while this year has been a slow growth for the economy at about 6.5% compared to 8% in FY24, I think we are unlikely to see any material pickup in our growth or any material growth recovery from here on in next year as well. If at all any recovery in the growth will be more modest. So probably we are in for probably a 6.5% kind of a growth over the next 6 quarters, and any recovery is probably 4 to 6 quarters away from where we are. So our view is that probably we are in India is in the middle of a cyclical slowdown, and in context of that, when you're the most expensive equity market in the world and you hit an air pocket like this, which was not so widely anticipated, then it's very obvious that markets will take a pullback and foreigners will pull capital away, and which is what exactly we are seeing.
Okay, Pankaj, great to have you on the show. Thanks as always for your time.
Thank you so much.